Doing? I hope everyone had a great New Year's. I'm happy to be back in the saddle and back doing these. I was actually away in the Dominican Republic in December, so that was when we had our reverse mortgage seminar, and I had a couple of people co-host that, including somebody from one of the reverse mortgage lenders themselves. So hopefully everyone that attended that got some good feedback and had a good time. Today, we're going to be talking about refinancing and ensuring that your home equity is working for you. It's been a really interesting couple of years, especially with COVID. And although the marketplace today has been decreasing, if you look back, people still have more equity in their home than they did a couple of years ago. And so there's a lot of opportunity to be looking at what to do with that equity. What I wanted to do is talk a little bit about the different options that you have to invest that equity. What is a home equity line of credit? What is the difference between good debt and bad debt? Some of the tax saving strategies. It's really important to understand the tax saving strategies that you can employ when you're utilizing your home equity. And then I want to talk about the different things that you can invest into. You can invest in real estate, you can invest in private lending, you can invest into exempt market dealers and private equities, you can invest in stocks. And I want to go through a bit of a comparison to help you choose which investment to make if you decide to do this. And of course, if you have cash, you can obviously use that too. You don't have to borrow money to invest, but there are obviously some advantages. In most cases, a lot of people are in a position where they just don't know what to do with their home equity, and most people just let it sit there. The reality is, letting your home equity sit there doesn't really help you or do much for you. It's not working for you. Other than the appreciation of that home, there is no real gain if you have a completely paid off home. And so what a lot of people do is they try to grow their wealth. And one of the ways that you can do that is to actually smash that piggy bank and tap into that home equity. So let's talk a little bit about how you would do that. One of the things that people often get into this situation, and this is a very common thing that we get asked, what should I do? Should I increase my investments and put more money into those, or should I pay down my mortgage? And it's a really interesting question, because at the end of the day, in many cases, the short answer is, well, if I can invest my money at a higher rate of return than what my mortgage is costing me, then that's an easy solution to look at. And of course, now the interest rates have risen so much in the last, really, it's been about 12 months or so. A lot more people are thinking, oh, maybe I should just pay down my mortgage. What I want to talk about, however, is that you can actually do both at the same time. And so how would you do that? Well, if you have the proper structure and what we call this as a home equity line of credit or a readvanceable mortgage, you can actually do both at the same time. A readvanceable mortgage is effectively a mortgage where as you pay down the mortgage, the line of credit limit will slowly increase. And so if I use this as an example, let's say that you had a property worth $500,000 and you had a $225,000 mortgage, so that's the number in red there, you could get a line of credit for $175,000. You can get up to 80% of the property value in total. And what you can do then is you can actually borrow against the $175,000 to invest. Now, the cool part is that you can take that cash that you have and you can pay down your non-tax deductible mortgage. So the $225,000 that was used to purchase your home originally, or maybe you refinance your home to do some home renovations or whatever. But as you pay down the mortgage, the line of credit limit will actually increase. That's because the lenders will give you an approval for a global limit. And again, that global limit can be up to 80% of your home value. And so if your home is worth $500,000, you can get a total of 80%, which is $400,000 available to you. So you already have a mortgage of $225,000. That means you can get a $175,000 line of credit that can be used to invest. And then you reborrow against the money that you've accumulated in equity, and you use that to borrow and actually invest those funds. Now, there's a really important thing that you want to look at here, and that's the difference between good debt and bad debt, because obviously you're borrowing more money. But at the end of the day, there's a really big difference between borrowing money to by depreciating assets. So buying consumer goods. If you're borrowing money to go and buy a new pair of shoes, in general, I know there's some ladies out there who are going to say, no, these Louis Vuittons or whatever, they're going to appreciate in value. Of course, there are some circumstances where consumer items can actually go up in value, and particularly collectibles. But in general, buying consumer goods is not considered good debt. It's considered bad debt if you're borrowing to buy things that will decrease in value, because that means that you're paying interest on assets that will decrease in value. So you're paying more for assets that are going to go down in value, which is not a good thing. Now you have good debt, and that would be borrowing money to buy appreciating items. So borrowing money to buy real estate or stocks, that's generally considered good debt. Now there's something that's even better, and that's tax deductible debt. And that's really, there's not a huge difference here between good debt and tax deductible debt, except for how you structure things from a tax perspective. And so whenever you're borrowing money to invest, the money that you borrow and the interest cost on that money is typically tax deductible. Now, at the end of the day, what you're trying to do is you're trying to build your net worth. And the way to do that is to look at assets minus liabilities as the net worth. And so if you're looking at, buying houses and whatnot, those are good assets. Buying cars, generally not as good. Obviously, the liabilities aspect is something that's a concern. But overall, your main goal is to build the overall net worth, having more assets than liabilities effectively. And so this is what you're trying to do over time. And so even though you are borrowing money, you want to look at, what am I borrowing money for? Am I borrowing money to purchase depreciating assets or appreciating assets? And that determines whether that's good debt or bad debt. Now, in order to structure your mortgage to save in taxes and make it tax deductible, which is taking that good debt and turbocharging it, you want to be able to make sure that you're structuring the mortgage properly. So how does it work? What you want to do is you're basically just making your mortgage payments on your mortgage, and then you're re-borrowing the principal that you've paid down, investing that. And if you've borrowed money with the intention of earning a return, then you get to write off the interest portion of your payments and your taxes. Now, what it really comes down to is the use of funds. And so it's very important that if you ever get audited by the CRA and you're trying to write off your interest costs, you have to show that you borrowed money not for personal consumption, because that is not tax deductible. But if you're borrowing money with the expectation of generating income or a return, then that money should be tax deductible. Now, I always have to say, you always need to talk to your accountant and make sure that there's very clear what you're intending on doing, and making sure the accountant gives you the green light to ensure that you are able to write off the interest portion of your payments to be compliant. But in general, whenever you're borrowing money to invest with the intention or expectation of generating income, that should be tax deductible. And so this is a really important thing to wrap your head around. Now, one thing that I do find, and this comes up a lot, you can borrow against your residence. And if you're borrowing money and investing the money into something, then the money that you just borrowed against your home would be tax deductible. You can't flip it around, and you can't borrow against a rental property and use that money to perhaps purchase your own personal residence. Whenever you're borrowing money for your own personal use or personal consumption, that money is not tax deductible. And so just because you're putting money and borrowing against a rental property doesn't mean that it's automatically tax deductible. It is the use of the funds. It's why you can borrow against your residence, which is typically not tax deductible, if you are investing the money. But you can't flip it and expect that you can also write it off. You can't borrow against an investment property and not invest the money. If you put it into something that's considered personal consumption, then you cannot write off the interest. You can borrow against a rental property and then use that to invest some more, and that money is still tax deductible. But it's very important you understand that it's the use of the funds that determines the eligibility of being able to write off the interest, not which property the money is secured against. Now, what do you do once you've borrowed money against your home? Typically, the easiest way to look at this is you're just trying to create a spread. So if you can invest the money at 9.95% and borrow it against your home on a line of credit, right now, most lenders are prime plus 0.5%, which is 6.95. In most cases, what we're recommending to clients right now actually is to go with short-term fixed rates, because short-term fixed rates are at lower interest rates than lines of credit are. So you'd be able to create an even larger spread if you were to do it that way. But in general, even if you're borrowing money in a line of credit, which currently is going to be one of the highest lending rates that you could be taking, you're still able to create a spread depending on what you're investing the money into. So if you're investing money into maybe being a private lender, a lot of private lenders right now are charging rates at about the 9.95% range. So you could, in theory, borrow money against your line of credit, lend it to somebody who needs a private lender, so somebody that doesn't quite qualify with a major bank, and then you could be making, let's say, 9.95% on that money and just creating a spread on money that you haven't even saved up. You're just tapping into your equity to access it. And the nice thing is you're able to offset the taxable gains of earning that income at 9.95% by being able to write off the interest cost of borrowing the money at 6.95%. So it's an interesting concept here. And one of the things we found is a lot of people are a bit more hesitant to borrow money against the residence in today's climate. And in many areas, that is true, especially when you look at what type of investments you can make in today's climate. And so this is something that we're finding is a question that comes up a lot. Sure, Kyle, I could borrow money against my home, but the cost is not as cheap as it used to be, even just a year ago. Just a year ago, you could borrow against your home and the prime rate was 2.45. So a line of credit would be 2.95%. Major difference between 6.95%. So the question is, what do I do? What do I invest my money into? And there's quite a few different options that we see. And obviously, this is not an extensive list. But most of our clients end up either borrowing money to invest in real estate. They'll buy cash flowing rental properties. Obviously, that's harder to cash flow properties in today's climate, especially in major urban centers like in Vancouver or close to Vancouver or in Toronto, et cetera. But if you can find properties that may cash flow, then that's obviously a good spot to be looking. Investing in stocks, obviously the stock market is down considerably over the last 12 months. And so we want to be very careful about what you're investing your money into if you're going into the stock market. But long term, in general, stocks do perform, 5 to 10% per year, reasonably consistently over the long term. Or there's other investments like private lending, which I get into a bit more in detail, and private equities as well. So there's a number of different things that if you can access your equity, you could look at parlaying that into a number of different options. So if we were to look at investing in real estate, well, why invest in real estate, especially with the current climate and where interest rates are right now? Leverage is one of the number one reasons to invest in real estate. And regardless of what interest rates are today, the leverage is one of the areas that you make the most money in by buying real estate. And that's because if you buy an owner-occupied home or a second home, you can put as little as 5% down. And if you buy a rental property, you can put as little as 20% down. Now, what that means is that you're putting down 1/5 or 1/20th of the total asset value, but any appreciation that you earn is based off of the total asset value, not the amount that you put into it. So let me go through a really quick idea of what kind of returns you'd be looking at if you were to buy real estate in today's current climate. If you bought a rental property, cash flow, it's pretty tough to find cash flow right now. Like a good property right now might be 0% cash flow. Just something that covers itself is actually quite reasonable right now. Now, obviously, with these types of numbers, I find that a lot of the properties that we're analyzing today are actually slightly cash flow negative, even the better operating ones or the better cash flowing ones. So one of the things that I always try to take into consideration here is that as of today, interest rates are at a high, and we do expect that in the next couple of years, interest rates will start to come back down again. So if you're finding that everything that you're finding is cash flow negative, don't be too discouraged. It is a current climate, and I like to stress test it in both directions. What happens if interest rates continue to rise, or what happens if they fall in the next couple of years, and see where that lands. But in general, a decent rental property today would be break even. Now, that appreciation factor, let's paint a picture for you here. So if you bought a property for $1 million and you put 20% down payment, which is $200,000, if you did that and the property value went up from 1 million to 1.1, so the property value went up by 10%, your return on your capital is not 10% because you put $200,000 in. So if you make 10% on the $1 million, so $100,000, on an investment of $200,000, your return is actually 50%. That's a return on your initial investment. And so one of the interesting things here is that the appreciation factor, if you put 20% down, that means for every 1% of property appreciation, your return on investment is 5%. It's 5 times that. And so in general, for our models, we usually use an expected annual appreciation over a long period of time of about 3% per year. Historically, over the long term, it's been much higher than 3%. I think for the last 30 years in Greater Vancouver in particular, it's probably between 6 to 8% on average. but we like to use about 3% because that's a bit closer to the national average. And we also don't want to expect that what's happened in the last 30 or 40 years is definitely going to be true for the next 30 or 40 years. So we use about a 15% annualized appreciation there. And then we have the mortgage pay down. And this is the one thing that people don't think about a lot, is what is your return from having the tenant pay down your mortgage for you? So if you bought a property for $500,000 and put $100,000 down, so you're 20% down, and let's say that the tenant is paying down that mortgage, they're probably paying down about $5,500 to $7,000 per year on the mortgage at today's current interest rates. And on that $100,000 investment, that would represent about 5.5 to 7% return on your money. This is the one thing that people don't really think about, is the return from the mortgage pay down. So if you found a property that you expected about a 3% annual appreciation on, and it had zero cash flow, you'd still be getting somewhere around the 20% mark as far as the returns are concerned. And you can find something where there's better cash flow. Maybe you're getting up to 3 or 4%, and the mortgage pay down is slightly better on that property because maybe interest rates normalize or drop a little bit. You might be getting up to about 26%. Now, not too long ago, these numbers were better because with low interest rates, the cash flow return was stronger and the mortgage pay down was stronger. But the important thing here is, even if you think that you can't find something that will cash flow positive and you can only find something that will pay itself, and so the tenant's just covering your expenses, and even if the property values don't go up at all, and there's no appreciation for, let's say, a year or two, you still have somebody in the home paying down a mortgage. That represents a 5.5 to 7% return on your capital per year based on current interest rates. And so that's something to keep in mind, because a lot of people are worried about where to put their capital today. You don't know if the real estate market's going to go up or down. You don't know if you can get cash flow today. Maybe it's just break even. Well, if you look at the stock market as an example, are you getting even a 5.5 to 7% return in the stock market? It's more difficult nowadays to get a positive return in a falling market, especially depending on how you play the stock market. So this is if you're buying rental properties and owning the real estate itself. I have found over the last 6 months in particular, a bit of a switch. A lot of our seasoned investors, instead of buying the assets, have said, you know what, I'd rather be a lender on the asset. And so we have people that are interested in being the bank instead of being the owner of the property. So private lending is a bit different because you're just lending on real estate. And there's a number of different types of loans that you can do. You can do deposit loans. So we do this frequently in our office, where we have somebody's buying a home and needs to put up a deposit, but their liquid cash is currently sitting in their existing home, which is sold but hasn't closed yet. Sometimes we'll do short-term deposit loans, and sometimes these can be fairly lucrative for an investor to lend on. You can lend to people that are doing flips. It's very hard for people to get bank loans when they're financing properties that are in really tough shape. And so we do a lot of private loans for people that are flipping properties. Development deals. Development deals are very common to run into issues getting bank financing. So a lot of the time, development deals end up going to private lenders. And sometimes those can be institutional private lenders or very large funds. Sometimes they can be individuals. On the development side, for instance, just to give you an idea, I'm currently working on a deal, on a development deal where we have a large fund that looks like they're going to lend money. They're going to probably lend about $2 million, just a little under $2 million on a piece of property. And they're charging about 12% or 12.5% on that money. And then we're looking at getting a second mortgage behind that. And that second mortgage lender will probably make somewhere in the mid-teens. And so, of course, on a style development deal, there's always some risks of being lending on bare land. In this particular case, the combined value of both mortgages together will be a little bit underneath 50% of the value of the land. And yet the second mortgage lender will probably be somewhere in the mid-teens for their overall interest rate and overall return. So there are good opportunities for those that are interested in those types of deals, because we're finding that the difficulty of deals has increased a little bit, but so too has the expected return on these deals. So yes, the interest cost for you to borrow your money on a line of credit has increased, but also if you look at being a private lender, a lot of the private lenders have just increased their rates, because a lot of these large funds, maybe they have $200 million under management that they lend out and whatnot. A lot of time they actually have big lines of credit with the bank too. And so when their line of credit rate goes up, then they have to charge a higher interest rate to the borrower in order to offset that. So lots of interesting deals that come across our desk all the time. We have done webinars previously on private lending and whatnot. And so if you are interested in learning more about that, then check out our private lending webinar, or you can send us an email and we can send it over to you. Also, this particular deal, I am looking for about $2 million on a land loan. If it's something that you'd like more details on, then feel free to email us and reach out, and I can give you some more details, as I have a couple of lenders that I think may do it, but it is a tighter closing, and so we're always looking for people that are interested in becoming a lender. Other types of mortgages, you can just very basic first mortgages, second mortgages. You can be a third mortgage. You can be a fourth lender. Obviously, there's more risk involved the further back the chain you are, because if there's a default, the first lender gets paid all of their money before the second lender gets paid any of their money. And then they get paid all of their money before the third lender gets paid their money. So the later on in the chain you are, the higher the risk, and therefore usually the higher the rate of return that you can expect being in second position, et cetera. It's quite rare that we do third mortgages. It comes up every once in a while, but it's usually quite rare. And then of course there are short-term loans. Somebody needs money for 60 days or 30 days or whatnot. And again, these loans can be fairly lucrative. So there's lots of options to becoming a private lender. And we do have some private lenders that just have a big fat line of credit on their home. And that's what they use to do loans. When the right loan comes across their desk, then they write the check using their line of credit. And then if that loan gets paid off, they just pay off their line of credit and then just wait for another deal to come across their desk. You can also talk to exempt market dealers, and exempt market dealers deal on what are called private equities. And so private equity essentially allows you to be a small part of a big deal. And so if somebody is building a large apartment building or doing a large development deal, a lot of things like this, then a lot of time they'll actually raise equity capital using a private equity company. And what you're doing is you're essentially investing your money in often a real estate backed investment without a lot of effort. So, buying real estate, lots of effort, but pretty good returns on actually owning the real estate. Being a private lender, less effort, but still some effort. You still want to be making sure that you understand and look at the due diligence, review the documents, review appraisals, review everything, and make sure you feel reasonably comfortable with the deal. And you still have to move the money around a little bit. However, being an exempt market dealer, it's fairly simple. You're going through the due diligence to see how comfortable you are with it, but there's a lot more compliance in the exempt market dealer market. And in general, an exempt market dealer is doing really good due diligence on any of these projects before they recommend them to anybody. And so, the high level components of private equity is that it is passive. It's a hands-off way of investing in real estate. You don't have to qualify for a mortgage, which is really key. For those of you who have obtained a mortgage in the last, couple of years, how much difficulty there is with getting a mortgage. So that's something to consider. Also, small minimum investments. Some private equity firms have larger private minimums, but some are as low as $25,000. You get to diversify. A lot of these can be RSP and TFSA eligible through Olympia Trust. The downside, however, of investing in these types of funds is that often the investments are illiquid. So they often have to sit in there for 3 to 7 years. They can take longer than expected to exit, so you have a little less control. And they can be considered to be higher risk because it might be you investing in a development deal or something along those lines. Now, who can invest in private equity is not just for people in blue and black suits. Yes, I am wearing a blue and gray suit today. It's not just for people like me. It's for anybody. A lot of people are able to do this, and especially because there's a lot of compliance and a lot of review about what type of projects people are allowed to invest into. So it's for eligible investors and accredited investors, and it's designed to provide a passive, hands-off way of investing in real estate. Now, you can also invest in stocks, of course. There's nothing wrong with investing in stocks, or you can invest in real estate. Sit back, relax, and watch your investments grow. Investing in stocks is usually going to cause a lot of stress, but investing in real estate, obviously those of you that have, it is much more relaxed and chill. I have used this picture for many years. I haven't found a better picture to show somebody really chilling and relaxing, sitting on the couch and having a Bud Light. Unfortunately, I wish this photo was a higher resolution, but I still really like it. Now, there's so many different options. So how do you choose between what type of investment to make? I did like to put together a bit of a chart here because I think it makes it a little bit easier to understand the differences between everything. So if you're purchasing real estate, you do have to qualify for a mortgage. Private lending, you do not. Now, with an exempt market dealer, sometimes you do have to qualify. You might need to be an accredited investor, which means you have to have a certain net worth or a certain income in order to qualify. So just be aware of that. And with stocks in general, you don't have to qualify in order to buy stocks. Average total return on investment with real estate, we talked about that being between 20 and 30%. Private lending, in general, your total return on investment is anywhere from 6 to 12%. I would actually say that recently the returns on being a private lender are probably actually higher, up to about maybe 8%, up to closer to 15% for your typical private lending deal. And so the returns at 6 to 12% were only just a couple of months ago, and interest rates have risen very quickly. And so the private lending returns have also risen. Exempt market dealer, this is a really big range, and it's really difficult to put a number on this, but I've seen numbers and pro formas for certain types of deals that are closer to 7%. A lot of them, I know the target is usually around 20%, slightly higher, sometimes up to 25%. I've also seen certain exempt market dealers who have had returns that are closer to 30% on a number of their projects. And so it really depends on the market and the circumstances and what type of deals they're doing. So that number can be really, really wide. Stocks in general often are between 5 to 10% once you factor in any dividends that you're buying your stocks, et cetera. Obviously, some people can do way, way better with stocks. So I guess when I'm referencing 5 to 10%, that would be more of a passive investment, buying funds, buying a mutual fund or buying an index. You're usually getting something around like 8% or so per year if you're buying an index. So that's something to think about. Cash flow. On the cash flow side specifically, buying real estate is on the lower end of the range out of all of them here. You're usually not making a lot of money on the cash flow from real estate for buying today. On private lending, you're obviously getting close to 8 to 15%. So I guess the average total ROI wasn't updated, but the cash flow was. So in general, today you're looking at between 8 and 15% cash flow. And of course, the cash flow for private lending and the total ROI are the same because that's all you make. You don't have any appreciation, you don't have any mortgage pay down when you're doing private lending. You're just lending out the money and receiving cash flow back. An exempt market dealer, a lot of these have zero cash flow depending on the deal. Some of them do have some cash flow component to it. So some of these you can get up to maybe 5% on the cash flow, depending on the type of deal. But a lot of them are putting your money in for 3 to 7 years until the project is finished, and then you get your money back. And the stocks, you're typically looking at maybe 3 to 6% if you're buying dividend stocks. I mean, 6% might be a bit high in today's climate, but in general, buying stocks, you're just receiving a dividend. Now, the term of the investment is important too. How long are you going to hold this asset for? The term of the investment would be generally 5+ years is what we recommend. And just an FYI, any questions, pop it into the Q&A and I'll be happy to answer it. We're probably about 5 or 10 minutes away from finishing the presentation, and then I'm happy to answer any questions that anybody has at the end. Private lending, usually the term is 1 year or longer than 1 year. So most of the time, most private lending deals are done on a 1-year basis. That's usually the length of time that's needed in order to get an exit strategy. But it really can depend on the situation. An exempt market dealer, usually between 3 and 7 years. That's usually the range. And then stocks, 1 minute to 1 lifetime. You can buy it and sell it a minute later if you choose to. You can own it for your entire life. So there's a really wide range here on how long you can hold stocks for. Now on payout frequency, generally buying real estate, you're receiving monthly income on it, and then you're also receiving money upon the refinance or the sale. Private lending, you're typically getting paid on a monthly basis is what we find most common, but sometimes you'll see that the payouts could be quarterly or annual, especially if you're investing in what's called a MIC or some kind of fund. A lot of the time they may pay out monthly, but sometimes they'll pay out quarterly or even annually if you're investing your money into a fund. Exempt market dealers, sometimes it's monthly or quarterly. but often it is at the end of the term. And then stocks, a lot of the time the money gets kind of rolled back into the portfolio. But if you have dividends in your stocks, then often those are paid quarterly. Volatility, this can definitely range quite a bit depending on the asset. I would say that real estate volatility is probably medium. You're looking at what happens with the real estate values. I would say the volatility is fairly medium there. Private lending is reasonably low risk unless you're doing high risk private lending. Exempt market dealer, I would say in general, most of them, if it's a good project, is anywhere from the low to the medium end of the range. Sometimes these projects can be considered high risk if it's a pure development deal, but it really depends on the situation. But usually there's not a lot of volatility with these. Usually an exempt market dealer is looking at a project and saying, you know what, we're quite sure that if we build this out, that this is what our expected return will be. And so there's not as much volatility on the day-to-day side of things versus just buying a piece of property. And then there's stocks as well. And of course, there's lots of volatility in stocks. They're up and down every single day, which is part of the fun of it, I guess. Liquid. So buying real estate, liquidity is quite low. Private lending, a little bit higher. It's probably medium because it's usually a one-year term that you'll find in general. Exempt market dealer, I would say the liquidity is quite low. It's more difficult to get your money out of exempt market dealer funds. And the stocks are quite high. That's one of the benefits of having stocks. And then RSP eligibility. Purchasing real estate, no. Everything else, there are ways that you can put the funds that you have in RSPs into private lending, investing in private equities or stocks. Now, the key with all of that is that we generally advise people to diversify and not to just do one thing. Of course, I'm very real estate biased and real estate heavy. I believe in owning real estate, and I think that that's one of the best investment classes that you can make. But at the same time, too, it's important you have liquidity too. If a lot of bad things all happen at the same time, you need to have liquidity so that you can offset all of those bad things coming up. So this is really important to think about. And so when you're looking at, what our clients are doing and what we're finding, a lot of the inquiries and discussions that we're having today, a lot of our clients were reducing their payments and paying off higher just debts by refinancing. So a lot of the time, if you have any debt that's accumulated, that's always first step, number one. There's no point in doing any of this investing stuff if you're borrowing money on credit cards at 18% or 17%. You should be trying to roll all that up into your home equity and paying all that off and at first. The next thing is learning how the Smith maneuver, and that's basically the fancy term for what it's talking about, how you can write off the interest portion of your payments when you're borrowing money to invest. That's commonly called the Smith maneuver. So you want to learn a little bit more about how that can help you save thousands of dollars in tax with very simple changes to the way you operate, and really having a good grasp of what is tax deductible and what is not. There are a lot of tools, and we have a lot of information that we can share to help give you the information that you need to understand that better. What are finding a lot of clients are doing, getting access to capital to invest and preparing to earn a spread on the interest return on the interest cost versus the returns that they're getting. Now, I will say that a lot of our clients are getting prepared, getting the money ready, and then not a lot of our clients are pulling the trigger and buying real estate because they're all trying to figure out what exactly is happening with this real estate market. And who could blame everyone? I mean, it's a very interesting market. It seems like it's a low supply market, low demand market. Buyers and sellers are kind of drawing a line and saying, I'm on this side and you're on that side, and nobody's moving. The same properties that were for sale a month ago are still sitting there. The same buyers that want to buy but haven't bought yet are still here. Kind of a weird time. There's not a lot of activity. And so we're finding that a lot of our investors are getting prepared. It's always, however, important to understand that in a low supply, low demand market, if there's not a lot of buyers in the market, then what you're going to find is that if there is a seller that is motivated and must sell quickly, then if you're one of the few buyers around, then you can get a deal by giving the seller the other terms that they want. Not price, of course, because you want to negotiate hard, but by giving them a fast closing or being accommodating with the closing, or being accommodating in other ways, or just happening to be a buyer in this market. So we're telling a lot of our investors, don't rush and buy the first deal you see. You're going to want to observe this market and kind of understand, get your head wrapped around what's happening in the marketplace. But there's going to be a few desperate sellers who need to sell. Maybe they're slowly eroding their savings and they really need to sell before they start to default on their mortgage payments. And we some people that need to sell and need to sell quick. And if you're one of the few buyers hanging around and you have a line of credit ready to go, you can write a check to either buy it outright, or at least you have your down payment already ready to go. You could close quickly and be a really competitive offer in that type of market. So I highly recommend that if you don't already have a line of credit set up, that you do so. The other thing is utilizing home equity to buy rental properties. And so obviously some of our clients are doing that. I did find, oddly enough, a bit of an uptick in activity in December. So late November, early December, we started to see more clients starting to buy properties. And so we have more closings coming up in January and February. So it seems like in some ways there's a bit more activity all of a sudden near the end of last year. I don't know if that trend is going to continue or whether that's a small short-term blip, but we have seen a little bit of activity actually come back. So I found those kind of interesting. Now, one thing that you also need to know is that the government, as of June this year, is going to be changing the guidelines, and we'll be making sure we send out some more correspondence on this shortly. But you will not be able to get up to 80% financing for a re-advanceable mortgage anymore. And that means that if you have a property worth $1 million, and right now you have a mortgage for $600,000, you won't be able to get a re-advanceable mortgage where you get $800,000 in total equity available, where you can re-borrow up to the $800,000 limit without having to re-qualify. They're going to cap it at 65% soon. And so there is a bit of a time constraint with this. So if you do want to get access to up to 80% of the home value, then you do need to act sooner rather than later on that. And so we're making sure that we correspond with our clients and describe what exactly the rules are, because that's something that you do need to keep in mind. You might not be able to get access to as much capital in the next few months as you can today. So overall, it's January. It's a really good time to start planning and start to figure out what your retirement strategy is going to be and getting that on place. If you'd like to learn more from us, you can always visit our website. We have our webinars coming up, but we always do it on the first Wednesday night of every month at 7 p.m. The next one is a bit of a unique one. We're doing a webinar about managing cash flow in a higher interest rate environment. We want to make sure that we communicate what options are available and some of the things that you can do in order to improve your monthly cash flow, because we know a lot of people are very concerned about managing their cash flow in this type of climate. We also have our investor survival guide. We have a private lending package for those that want to learn more about private lending. So you can always check out our website and download those items. Of course, if you want to learn more specifically about any of these strategies, you can book a consult with one of our team members, and we're more than happy to help you with that. I also, at my office, we have a number of Smith Maneuver books sitting around. I always make sure I have a bunch. So anybody that wants to learn more about the Smith Maneuver, just send us an email to info@greenmortgageteam.ca. So that's info@greenmortgageteam.ca, and just ask for a copy of the Smith Maneuver book and put in your mailing address, and we'll happily put a copy of this in the mail. Also, I'm sure a number of you that have watched my webinars before know that I was an author of a best-selling book called Rockstar Real Estate Investing. If you'd like a copy of that book and you don't already have it, then again, same offer applies. I have a lot of copies of my own book, not because I have a huge ego, but I know that a lot of you could use it. So I have a copy, and I'm happy to send it out to every one of you that would like a copy of it. And if you have any questions, please reach out to us, website greenmortgageteam.ca, or email info@greenmortgageteam.ca. So I'll open up for questions now, as I see there's a couple of questions in the Q&A. Mike asks, hypothetically, if I max out my HELOC based on current equity, but my equity drops, say 20% 1 year from now, would the lender expect a payback to get in line with the new lower equity? So the question is, if I refinance with 80% today, but then the property value goes down in the next year, will I have to pay that back? And the answer is no. And residential financing, lenders don't reevaluate that loan year over year based on the value at this particular time. So there's been some talk about maybe banks considering having to do this, but at this particular time, the answer is no. We will find, however, that lenders are going to be reevaluating the amount that you can get access to on a HELOC after June 20th. So if your renewal is coming up after June 20th, then they are supposed to be looking at changing the amount that you can do on a readvanceable. Long story short, what this means is that if you have a property worth $1 million and you have a, let's say it's a $600,000 mortgage and a $200,000 line of credit available to you, the lenders will eventually say, well, you can't re-advance up to 80% of the value. You can only go up to 65%. Now, what that means is that if your line of credit is empty, then they may have to reduce the line of credit from $200,000 to 50, because that means that you'd only be borrowing a combined 600,000 plus 50 is 650. That's 65% of the $1 million value. Now, one of the things we're wondering about, and we think this is going to be a bit of a loophole, is if you have a line of credit and you're coming up for renewal after June of 2023, if you just borrowed the $200,000 as a mortgage term, and now you've got a $600,000 mortgage and a $200,000 mortgage, so combined $800,000, they're not going to ask you to repay that extra $200,000 because it's an amortized mortgage. So their issue is that if you're paying down those mortgages, you will not be able to re-advance the principal that you pay down on that $800,000 in total until you've paid down the mortgage debt to less than 65% of the value of the property. So they just don't want you using your home as an ATM machine unless you have at least 35% equity in your home. So you've only borrowed max 65% of the value. Now, one of the things you can do is you can refinance before June, and that buys you, if you go into a longer term mortgage, then it'll buy you extra years where you have a re-advanceable product that can go all the way up to 80%. So it may be worth, for those of you that have a renewal coming up after June, it may be actually worth considering refinancing before June, because then you won't get stuck with having to adhere to the new guidelines and rules. Awesome. Olga has a question. So in the current interest rate environment, would be worthwhile strategy simply paying down the mortgage from the HELOC when refinancing to reduce mortgage payments while paying interest only on the HELOC? It is an option, Olga. I'm not a huge fan of the option because yes, you're paying a lower payment by utilizing your HELOC to pay down your mortgage because a HELOC has an interest only payment instead of an amortized payment. So that's one of the benefits, is if you're purely focused on what can I do to lower my overall payments, then yes, borrowing money in the line of credit to pay down the mortgage, you're just flipping the amount of debt you owe. It's the same amount of debt, but now more of it is interest only and less of it is amortized. However, a line of credit is typically a higher interest rate than the amortized debt is. And so that's the only flip side, is that although in theory, you have a lower payment to do that, you're paying more in interest on that, especially if you have a re-advanceable mortgage, because if it's a mortgage that you're paying down, you can actually re-borrow the principal that you're paying down on that mortgage on your line of credit. So in theory, even if you had difficulties making the payments, you can pull back all the principal that you paid down, and you paid less in interest, you paid down some principal, you can actually pull some of that money back and put it back in your jeans. So in general, I'm not a huge fan of that option. It is doable, but it's not a great option. Shella has a question. I want to invest in Edmonton, but unable to find a good real estate agent. Any suggestions? Absolutely. So if you send us an email, I'll be happy to provide you with a couple of recommendations on good realtors in Edmonton. Also, what are your thoughts on buying warehouses or storage spaces in Edmonton? Good question. It really depends on the market. I would want to do a bit more due diligence and research on that. Now, I haven't seen the Edmonton market take off in the industrial space as much as we've seen in, for instance, Vancouver, but industrial land in general has become much more expensive. The question is, will it become more expensive? I feel like industrial land is more in demand because a lot of people are buying goods online, and so instead of having retail shops where people go and buy stuff, all of a sudden now companies need more warehousing space so that they can reduce shipping times. So instead of having something shipped from China, especially with all the log jams with supply chain issues, et cetera, and trying to speed up the time of delivery, you're finding that there's more local warehouses that have a lot of goods in them. And so that's caused the industrial land to increase in value quite a bit. I'm just wondering if that trend will continue at the same pace it has, because I think that a bit of a premium is now built into industrial land prices. When I see industrial land, I'm a little bit concerned that the cash flow doesn't quite support the value that you're paying for it. but it really depends on where it is and whether there's some growth there. And so I think that you'd want to dig into this. So if you are looking at industrial and warehouses and storage spaces in Edmonton, then make sure you put that in the email over to us so we can make sure that it's the right type of realtor that we connect you with on that. Because a residential versus a commercial realtor are very different people. But that's something to definitely take a look at. Barrett asked a question: if my mortgage rate is quite low, 1.87%, congrats, and I have a HELOC, would you advise putting a lump sum towards my mortgage and then using my HELOC to invest in rental property? So there's no reason that you should borrow or use a lump sum to pay down your mortgage, especially if you're borrowing it from your HELOC, because your HELOC will be a much higher interest rate. However, this is a very interesting situation because your cost of borrowing is very, very low on that money. Even though you can create a tax deduction by doing so, you're also in an interesting position here where by taking the cash that could be earning you 5 or 6% in some other investment opportunity, there's a cost there. Now, here's the biggest challenge, Barrett, is that if let's say that you do this and you buy a property, okay, and you decide, okay, I'm not going to pay down my mortgage because it's a really low rate, I'm just going to use cash. As soon as you put cash into a deal for down payment, you can't reverse the fact that you use cash for down payment at any point in time while you own that asset. So if you own that asset for 10 years or 20 years, you're foregoing the ability to write off the interest portion of the payments for 10 or 20 years. And interest rates are not going to stay at 1.87% on your mortgage forever. And so I think that even though you'd be paying down a mortgage that's currently at a low rate, number one, rates will normalize. And when that mortgage comes up for renewal, your rates are going to go up and your cost of borrowing will go up. And number two, if you look at the overall cost of being able to write off the interest portion of the payments for 10 or 20 years, for instance, if you're going to own the property for a long period of time, I think that amount would probably outweigh that small little difference that we're talking about, where maybe you're paying off debt that's only under 2%, and you could be investing that cash at 5% and creating a spread between the two. So I have a feeling that if it's a long-term hold, the math will work out to be in your favor to still make the prepayment and do that. That's something that you want to do some math on. And so normally in a situation like that, Barrett, you'd want to reach out to us and we can do some math and calculate that for you. Also, you'd want to engage your accountant and make sure that you get some clarity on that too. But we've definitely done that math before for clients to give them some understanding of what's going on. Hey, Todd, are there any lenders offering competitive short-term rates, 1 year, 2 year, to try and wait out this continuing rate rising activity? So we're in an interesting spot where when interest rates started to rise quickly, and some of you may have heard of this, but the bond rates or bond yields have inverted. What that means is, so a bond rate or bond yield is, if I wanted to buy a bond, which is basically just something that is called fixed income, it just pays you out on an annual basis or quarterly basis, et cetera, a certain prescribed interest rate. It's actually what mortgage rates are based off of. So if a bond rate is right now about 3.5%, usually a mortgage rate will be 1.5 or 2% higher than that. And that's exactly where we see current fixed rates, somewhere in the 5.5% range. So on the higher end of that spread range. Now, what's happened, and this is actually a precursor to predicting a recession, is that the short-term rates are higher than the long-term rates. And so there's a couple of different metrics that people look at, but a lot of the time they compare the 2-year bond yield and the 10-year bond yield, and they compare that spread. And right now it's negative instead of positive. So the short-term rates are higher than long-term rates. So we're actually finding that short-term interest rates for mortgages are also higher than long-term rates. And we've seen, like, some banks for a 1-year term would have a rate around 6%, give or take, for a 1-year fixed. But they'll have a rate of somewhere around as low as, we've seen a couple of lenders around the low 5s for a 5-year fixed. So it's uncommon that you see such a big spread. Usually the short-term rates are lower or about the same as the long-term rates. But in this climate, we're actually seeing that's inverted a little bit, and the short-term rates are higher than the long-term rates. So long story short, most lenders are going to be around 6%, give or take, for 1 year or 2 year rates. If you're looking at a couple of credit unions in particular, are somewhere around, I think we're just looking today, and around 5.79%, I think, or 5.84, somewhere around there was what you could be getting for a 1 year or 2 year rate. So given what we're seeing right now, we're finding that some of our clients are opting to go on to a 1 year or 2 year just to stop the bleeding, because I think that rates have increased a lot more than people expected them to. I do think we're very close to the end of the rate cycle, but still there's a little bit of room for them to still go up a little bit. Carmen has a question, line of credit versus HELOC. So how is credit score affected by using HELOC for investing, and how will that affect future mortgage options on other investment properties? So in general, when you're looking at credit, usually as long as you're making your payments on time, then usually you're going to be able to maintain a high credit score, even if you have a big fat line of credit on your that's sitting on your credit score. So that the general consensus or general advice that we give to clients is that if you're good with all of your credit everywhere else, then having a big fat line of credit is not going to affect your credit enough to pull you from being able to qualify to not being able to qualify. Now, something that you want to consider here is that not with regards to credit, but with regards to qualifications. So the debt servicing, the amount of your debt that goes towards paying your payments, and how much you can qualify for based off of your income. If you have a big line of credit limit, a lot of lenders use the line of credit limit, not the balance outstanding, but the actual limit, and factor that in, assuming you're borrowing the entire limit when you go to qualify for that line of credit itself, and also for subsequent debts and purchases. So if you've got a big fat line of credit for $1 million in your home, if you're using a zero balance on it, most lenders will assume you're borrowing $1 million in your home, which can affect your ability to then qualify for rental properties. Now, there are a few banks and credit unions that we deal with that only look at the balance. And so there are some options and there's a bit of flexibility there. But that's something that you do need to keep in mind. But in general, in the credit score, there's a minor negative impact for having all of that debt sit in your credit rating. But in general, it's not enough to worry about if the rest of your credit is clean. So why are the feds reducing the amount we can borrow against our homes from 80 to 65%? So it's only the readvanceable component of it. And so that means that you can still borrow up to 80% of the home, but you cannot re-borrow your principal that you've paid down on that mortgage until you've paid it down below 65%. And so this is the big issue that we found. I think the problem is the government doesn't want people using their homes as an ATM machine. They don't want them paying down their home and then digging back into it and pulling the money back out. And I think it's I think because it's a tax strategy, I think that in particular is maybe one area and one reason that they're looking at this. But I think for the most part, they're not looking at this as, yes, people are just utilizing this as a tax strategy and people with really strong net worths. I wish there was some kind of qualifier there where if the client had the equivalent amount of assets sitting somewhere else, that they would allow this. But I think they're concerned with the average Joe who pays down their mortgage and then just keeps digging back into their home equity to buy consumer goods in particular. So I think in general, they just want to reduce Canadian debt, and our debt to household income levels are very high in Canada. In fact, they're higher than the United States, which the first time I heard that, I was quite surprised. But Canadian debt to income ratios are very, very high. And I think that there's some concern about the overall amount of housing related debt that Canadians have and how much that could affect us if interest rates rise. All right, quick question. Do you work with clients in Ontario and Newfoundland? So there are some new regulations and some new policies with regards to licensing in different provinces, and so there are some restrictions. And in general, there's more compliance revolving around this. Now, with regards to working with clients in different provinces, we do have people that we work with and brokers that we work with in a number of different provinces. So if you're buying in one of those provinces, we're happy to help. Currently, our team has the licensing in BC and Alberta, and we're just wrapping up our licensing in Ontario as well, because I moved brokerages and now we have to get re-licensed in Ontario. So we will be licensed in BC, Alberta, and Ontario, but we have contacts in all of the other provinces, and so we can help you. But typically, we don't usually do deals in Quebec and in the Maritimes, usually just because of the time difference and the licensing. There's another question. With your explanation on rental property equity and using that equity, can you simply take out equity to use personally? So yes, you can take out equity out of a rental property and use it personally. However, you do not get to write off the interest portion of the payments if the money was used for personal reasons. So if it was for personal consumption, then you don't get to write off the interest portion of the payments. So that's a really important distinction and clarity there. If you borrow against the property, a rental property, and then use the money to invest, then you can write off the interest portion of the payments. But if you borrow it for personal use, then you can still do that, but it's just not tax deductible on that portion. Hey, Sharon. Question from Sharon, between fixed term and variable term, which one will pay more into principal? Some brokers say fixed term will pay less than variable rates. Is this true? Really what it comes down to is the interest rate. The lower the interest rate, the more of that payment, a higher percentage of the payment goes towards paying down the principal than goes towards the interest. It's a very simple mathematical calculation or formula. Now with variable rate mortgages, it gets a bit more complex because some variable mortgages or some are adjustable rates and some are variable rates. And there's the term variable gets thrown around quite a bit, but it's actually different than adjustable. A variable typically means that the bank doesn't change your payments as the prime rate moves up and down. So your prime rate is static, and as the rates go up and down, the payment's not changing, which means that the amount that goes towards principal and interest is changing. And so you'll find that certain banks, as the rate goes up, your payment goes up. Some of them, the payment doesn't go up until you reach a certain threshold, and that's usually called the trigger rate. And all of a sudden, once you hit the trigger rate, then the payments will jump up to a new calculation. So depending on the situation, that can vary. But in general, Sharon, it really comes down to the amount going down towards the principal is based off of A, the interest rate, and B, the amortization. So longer amortization means less goes towards the principal, and a lower interest rate means more goes towards the principal. Patrick has a question: how easy is it to refinance with a variable interest rate and a readvanceable mortgage with these high interest rates? At the end of the day, the qualifications have definitely decreased. And so if we look at it, what clients were able to qualify for 12 months ago versus what they're able to qualify for today, I would say on average, our clients qualify for about 25 to 30% less money than they did 12 months ago. So that's something to consider. Now, the qualifications really come down to the borrower. And one of the things that we always look at is, as a broker, we shop over 40 different lenders to find the best rate and the best product. And when we say product often comes down to, which lender can use more rental income to qualify our client, which means we can get them more money. And so one of the main benefits we find with working with our investor clients in particular is that interest rates are very important when you buy your own home and you're getting started. But as a real estate investor, what you'll find is that if you can find a bank that will give you an extra $100,000 more than your bank, maybe we can find you a lender that will give you $100,000 more, and the interest rate is only 0.1 or 0.2% higher. Well, as an investor, if I can take that $100,000 extra and invest it at 10% interest, that's going to make up for a lot of a difference in interest cost on my mortgage. And so this is where it really depends on what your goals are. We have had clients, they'll break a mortgage at a lower rate, take a new mortgage with a new lender at a higher interest rate because they can get access to more money. And if they can lend out that money or invest that money at a higher rate of return, then we can actually do the math on it and see, whether we're going to be better or worse off by doing that. So it really, again, like most things that we do, it comes down to the math on it. But as far as qualifications are concerned, most borrowers are qualifying for about 25 or even as much as 30% less than they were 12 months ago. So it is more difficult for sure to qualify. Awesome. So I've gone through the Q&A. I'll go into the chat and just see if there's any other questions there as well. Let me just open that up. Okay, awesome. Let's see here. Yuri, I've read your book online, but it would be good to have a signed hard copy. Yeah, I'll make sure to give you a copy next time I see you, Yuri. One of your New Year's resolutions, do 2 flips in 2023. Noted. I'll help you do that. Okay. I have a couple of questions that we already answered earlier. Another question was, what do you recommend to investors with variable interest rates on readvanceable mortgages in this climate? It's a tough situation for sure. We do expect that as the interest rates have gone up, they will eventually come back down. There might be something to consider locking in the mortgage into a short-term fixed rate. Most banks will require you to have your lock-in term plus the time elapsed have to equal the original term of your variable mortgage. So what I mean by that is that if you took a 5-year variable and you're 2 years into it, then you have to lock into a 3-year fixed term or longer. But I do find the sweet spot right now to be a 1, 2, or 3-year fixed. Most of our clients are leaning towards 2 or 3-year fixed rates. Those are lower interest rates today than many variable rate mortgages. And on top of that, there's no further increases, of course, for that short time period. And we do expect that within 24 months or so, we expect that interest rates would be on the downswing. And so it might not be a bad idea to consider taking a locking into a short-term fixed rate if you're able to, or just hanging on and riding at the variable rate. Quick question here. If you have an open HELOC with only a small portion of it fixed, will the 65% restriction apply when the locked-in portion comes due? So it'll be likely when the locked-in portion comes due that the bank is supposed to reevaluate that mortgage. We still have not yet received great clarification from the banks on this, and this is why we haven't put out any information on it as to exactly what moments they'll trigger this, what they use to determine valuation. I can't imagine a bank wants to get property reappraised every time it comes up for renewal. So there's a little nuances here that we're very unclear of how a bank will deal with this. But our understanding is it's likely that when the fixed portion or closed portion of a mortgage comes due, that's when that trigger comes up. They have to reevaluate it and make sure that no more than 65% of that term is readvanceable. Now, it can still mean that you can have a readvanceable portion for 65%, but the other portion, at least 15% of your of that mortgage, has to be converted and locked in. So there might not be too many restrictions with regards to this, but something to keep in mind. And again, we're waiting for some more clarity on exactly what that's going to look like. Quick question. I'm looking for off-market deals in Edmonton and Central Alberta. Do you have any leads for good real estate agents for that area to find off-market deals? I mean, yeah, some realtors are definitely better than others to find off-market deals. If you send me an email and just list that question, then we can try to introduce you to a realtor or two. But I will say this: in general, realtors are finding on-market deals. And so, the real estate investors that I find those amazing smoking deals, they're out there, they're door knocking, they're meeting people, they're trying to connect with people, talking to people, and they end up finding deals that way. But it isn't easy. You're going to find that some people randomly just hit gold on a really, really good deal, and they connect with the right person because they found an off-market deal. But it's not easy. It takes a lot of effort and a lot of work to do that. Some realtors are going to have those deals, but the reality is you're going to have to develop a really good relationship for your realtor to send that deal to you instead of somebody else. If you don't have a really good relationship with them and you haven't shown evidence that you can close and will close on a deal that they bring to you, then that real estate agent is typically going to bring that deal to somebody that they trust that will close the deal. I've got one more question in the Q&A. Oh, it's not a question. It's a thanks. No problem, Scott. Awesome. Well, I think I've answered all the QA and all the items in the chat. So I'll wrap it up from here. Obviously, if anybody has any lingering questions, you can reach out to us. It was great to see a lot of familiar names here in the chat. Happy New Year to everyone, and we're here to help you reach your real estate and personal goals in 2023. So please reach out to us if you have any questions, and have a wonderful 2023. Thanks, everyone. Bye now.